Hello and welcome to Earnings Echo. We put together the most important information about Hims and Hers Health, Inc.
Yeah, let's dive right into this one.
I mean, we have to start with the immediate market reaction because it was pretty volatile, right? We're looking at Q4 2025. Give us the headline numbers first.
It's a complicated picture, actually. Kind of a good news, bad news setup for you today. Bottom line, they delivered.
Earnings per share hit 8 cents.
Handily beating the expectation of 5 cents, yes, but top-line revenue?
Came in at $617.8 million.
Exactly, which is a slight miss compared to the consensus of roughly $618.7 million.
Okay, but, a slight revenue miss doesn't usually cause an 8% after-hours drop.
No, it doesn't. The real issue was the forward guidance.
The Q1 2026 outlook.
Total shock to the system. Management guided for revenue between $600 and $625 million.
Wow, and the street was modeling what, like $654 million?
Around $653.9 million, yes.
Yeah.
So investors treated this as a classic sell the news moment. They saw that soft guidance and immediately hit the exit.
That is a massive gap between expectation and reality. So in this deep dive, we really need to unpack why. Is the core business decelerating?
Actually, the subscriber growth engine is still humming. They hit over 2.5 million subscribers.
Up 13% year over year, right?
Correct. The issue is tied heavily to margin pressure and a specific revenue recognition change. Gross margins fell to 72% in Q4.
Down from 77% last year. That is a steep contraction.
It is. A lot of that is international mix and new specialty launches, but there is a specific $65 million revenue headwind expected in Q1.
Okay, what is driving a $65 million hole?
A change in shipping cadence for their weight loss products.
Okay.
They are shifting to what is called 503A fulfillment.
Let's clarify 503A for the listener. That generally refers to traditional compounding, where prescriptions are made specifically for an individual patient, right?
Exactly. Not in bulk. Moving to that individualized model changes the timing of when they can actually book the revenue.
Oh, so the demand is still there.
Operationally, yes, but the accounting recognition is getting pushed out, creating that massive air pocket in Q1.
So it's a technical headwind. What about the growth segments, though? Are they picking up the slack?
They definitely are. U.S. revenue is up 53% year over year, but international absolutely exploded.
Up almost 400%, right?
399%, hitting $134 million. And we have to highlight the Hers vertical. That segment alone is rapidly approaching $1 billion in annual revenue.
Staggering. Hitting $1 billion essentially validates the entire dual brand strategy. But margins are compressing, and we saw massive spending announcements on the call.
Aggressively buying infrastructure and territory, they announced a definitive agreement to acquire Eucalyptus.
They're up to $1.15 billion.
Right, to instantly expand into Australia and Japan. They also closed the YourBio acquisition for $150 million.
Which is about verticalizing the diagnostics, owning the at-home test instead of sending you to a third-party lab.
Correct, owning the whole patient journey. But spending over $1 billion when margins are already tightening made investors nervous.
Understandably. Now we have to address the regulatory elephant in the room. With GLP-1 compounding safety concerns heavily in the news, did management address that?
They were very proactive. CEO Andrew Dudum emphasized that the vast majority of their revenue and profit comes from non-GLP-1 offerings.
Smart defensive pivot. He is decoupling the company's long-term thesis from weight loss drug regulations.
Exactly, telling the market that even if rules change, the core business is giant.
What does this mean for profitability right now?
CFO Yemi Okupe was clear. 2026 is an investment year. They will run those booming international markets near break-even.
Prioritizing market share over immediate margin expansion, delaying profits to win the land grab.
Precisely, and they are betting heavily on tech for retention.
Like the proactive care initiatives.
Yes, heavy focus on labs, wearables, and AI-driven personalized dosages.
So to wrap this up, what is the final echo for you, the investor tuning in today?
The story for 2026 is infrastructure. They are sacrificing short-term EBITDA margins, guiding for 11 to 13% to build out labs and international scale.
Short-term pain for projected long-term gain.
Exactly. Management reaffirmed their 2030 targets of $6.5 billion in revenue and $1.3 billion in EBITDA. They're willing to take the hit today for massive scale later.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked. Portfolio prepped. Catch you again soon.